there, and welcome to the Property Wealth Podcast. We're so glad you're joining us today.
Absolutely. It's great to have you here with us.
So let's dive right in. Today we're going to explore something that can really open doors for you in real estate funds, and LP investing basics.
Yeah, it's a fascinating topic. Many people think about direct property investment, but funds can offer a different approach that's often overlooked.
Exactly. We'll be breaking down what it means to invest in a real estate fund, the roles of general partners and limited partners, and how you can get started with minimal hassle.
And we'll also touch on the potential benefits and risks involved, so you'll have a well-rounded view.
Right, it's all about understanding what fits your situation best.
Plus, we'll share some tips on how to evaluate different funds and what questions to ask before you dive in.
So whether you're looking to diversify your portfolio or just starting out, there's something here for everyone.
Exactly. Let's get into it.
Yeah. Let's jump right into the first part. What exactly is a real estate fund?
You know, Sarah, when we talk about real estate funds and limited partnership investing, it's really important to consider why this matters. Especially for folks over 40.
Absolutely. I mean, at this stage in life, many people are starting to think more seriously about retirement, right?
Exactly. And as we all know, retirement isn't just about stopping work. It's about maintaining a certain lifestyle. Real estate can provide that. A steady stream of income can really help with that.
That's such a good point. I've spoken to many listeners who are worried about their retirement savings being impacted by inflation.
Yeah, inflation is a big concern. The cost of living is rising, and traditional savings accounts or even bonds just aren't cutting it anymore.
Right. The value of that money just isn't what it used to be. But with real estate, especially through funds, you can potentially hedge against that inflation.
For sure. Let me give you an example. I know an investor named Tom. He's in his early 50s and was really feeling the strain of rising costs. He was looking for ways to secure his financial future.
What did he end up doing?
Well, he decided to invest in a real estate fund. Tom liked that he didn't have to manage the properties himself, which, can be daunting. He wanted something hands-off, but still rewarding.
Smart move. So what was his experience like?
Initially, he was a bit nervous, but over time, he found it really reassuring to see that his investment was generating income. It helped him feel more secure about his financial future.
That's amazing. It sounds like it gave him a sense of control, too, right?
Exactly, and that's key for so many people. As we age, that desire for financial security becomes more pronounced.
Yeah, I can imagine. And what about market shifts? This can be such a roller coaster.
Great point. Market fluctuations can be tough, but investing in funds can provide diversification. You're not putting all your eggs in one basket.
Right. So if one property or sector is struggling, others might be thriving, and that balance can stabilize your returns.
Yes. And then there's the emotional side of it, too. Many of us want to leave something behind for our family.
Oh, definitely. Wealth transfer is a huge consideration.
I remember talking to a woman named Linda. She was in her late 40s, and her biggest worry was not just her own retirement, but making sure her kids had a solid foundation as well.
What did she do?
She started investing in a real estate fund. Her idea was to build wealth over time so she could eventually pass that down to her children. It also allowed her to involve them in the process, teaching them about investing.
That's so important. It's not just about the money. It's about the lessons and values you pass on to.
Exactly. And with the way the economy is shifting, real estate often remains a stable asset. It's tangible. You can see it, touch it. It provides a sense of stability that other investments might not.
That's so true. And let's face it, with the current economic trends, it's more crucial than ever to think about how we can not only protect our wealth, but also grow it.
Right. As interest rates fluctuate, getting into a real estate fund might allow you to bypass some of those challenges, especially since you can take advantage of experienced fund managers who know the market.
And that's key for someone who might not have the time or expertise to navigate the complexities of real estate investing on their own.
Exactly. Plus, many funds focus on income-producing properties, which can provide that cash flow you need, especially as retirement approaches.
It seems like a win-win situation. So for someone over 40 who might be feeling a bit overwhelmed, it really can be a practical step toward financial security.
Yes, and the beauty of it is that you don't have to do it alone. You can work with advisors or join groups that focus on these investment strategies. it can feel less isolating.
I love that. It's all about building a community around your financial goals, isn't it?
Absolutely. And I think that's what makes investing in real estate funds so appealing right now. It's not just about the numbers. It's about the peace of mind that comes with knowing you're making informed choices for your future.
So true. And as we move forward, we can dive into specific strategies that can help people leverage these funds effectively.
Sounds great. Let's explore that next. So Sarah, let's dive into some core strategies and rules of thumb for real estate investing, especially when it comes to LP investing in real estate funds. One of the first things I always tell people is the 1% rule.
Right, the 1% rule. Can you explain how that works?
Sure. The 1% rule is a guideline that suggests you should aim for a property to generate at least 1% of its purchase price in monthly rent. So for example, if you buy a property for $200,000, you'd want to see it earn at least $2,000 a month in rent.
That's pretty straightforward. But does that apply to every market?
Good question. It really depends on the local market conditions. In some high-demand areas, you might not hit that 1% mark, but the appreciation could make up for it. Conversely, in less competitive markets, you might find properties that exceed that rule.
Got it. So the 1% rule is more of a guideline than a hard and fast rule, right?
Exactly. And speaking of guidelines, another important one is the 50% rule. This rule states that, on average, you should expect about 50% of your rental income to go toward operating expenses. So if your property generates $2,000 a month, you might budget $1,000 for expenses.
That makes sense. What kind of expenses are we talking about?
Well, you've got property management fees, maintenance costs, property taxes, insurance, utilities. Those can add up quickly. And it's important to be realistic about those numbers to avoid surprises later.
Yeah, I can see how that could catch someone off guard. So, if you follow those rules, you're likely to have a solid investment?
Generally, yes. But remember, it's always good to do your due diligence. I recommend creating a deal evaluation checklist. This should include factors like location, property condition, potential rental income, and market trends.
What would you say are the top 3 things to look for on that checklist?
First, location is key. Look for areas with good schools, low crime rates, and amenities. Second, assess the property condition. Are there any major repairs needed? And third, look at the local rental market. What are similar properties renting for?
Those are great points. It sounds like doing thorough research can save a lot of headaches later on.
Absolutely. And don't forget financing options. There are several ways to fund your investments. You could go for traditional mortgages, private lenders, or even partner with others in a real estate fund.
What's the advantage of using a real estate fund over buying a property outright?
Well, investing in a fund allows you to diversify your investments without needing to manage properties directly. You're essentially pooling your money with other investors, which spreads the risk and often grants access to larger deals that you might not be able to afford on your own.
That sounds appealing, especially if someone wants to avoid the day-to-day management of a rental property.
Exactly. And another thing to consider is the different property types. You might invest in residential, commercial, or even industrial properties. Each has its own potential returns and risks.
What would you say is the most common type of property for new investors?
Generally, residential properties are more common for new investors. They're often easier to understand, and there's usually a larger pool of potential tenants. But commercial properties can offer higher returns, even if they come with more complexity.
So it's really about finding what fits your needs and risk tolerance.
Right. And one key metric to help evaluate potential investment properties is the cap rate. The capitalization rate is calculated by dividing the property's net operating income by its purchase price or current market value.
Can you walk us through an example?
Sure. Let's say you're looking at a property that generates $30,000 a year in net operating income and is listed for $300,000. To calculate the cap rate, you'd divide $30,000 by $300,000, which gives you a cap rate of 10%.
So a 10% cap rate would indicate a potentially good investment?
Yes, but remember to compare that cap rate to similar properties in the area to determine if it's actually a worthwhile investment. Higher cap rates can signal better returns, but they might also indicate higher risk.
I see. It sounds like understanding these metrics really empowers investors to make informed decisions.
Exactly. And one more thing to keep in mind is cash flow. You want to ensure that your properties not only cover your expenses, but also provide a positive cash flow. It's crucial for long-term success.
So let's say you follow all these rules and strategies, and you find a great property. What's the next step?
Well, once you identify a solid investment, you'll want to perform a thorough financial analysis. Look at your financing options, projected cash flow, and potential appreciation over time. Then, you can make a well-informed offer.
That sounds like a lot of work, but it's worth it in the end.
Definitely, taking the time to do your homework pays off, but it's also important to be aware of common pitfalls in real estate investing. So, one of the biggest pitfalls I see with new investors, especially those diving into real estate funds, is over-leveraging.
Yeah, I can see that. It's tempting to think that, using borrowed money can maximize your returns.
Exactly. But what happens is, they often stretch themselves too thin. You take on too much debt. And then, if the market shifts, or you have unexpected expenses, you can find yourself in a really tight spot.
Right. Like, I remember hearing about a guy who bought into a fund, and he was so excited about the projected returns that he didn't pay attention to the debt levels. Then, when the fund hit a rough patch, he was left with, a hefty financial burden?
Yeah, he ended up having to sell off other investments just to keep up with the payments. It's a tough lesson.
So what do you recommend? How can someone avoid that pitfall?
Well, I always say, start with a conservative approach. Look at your overall financial picture and keep your debt-to-income ratio in check.
Makes sense. And I guess having an emergency fund is crucial too, right?
Absolutely. That cushion can really help when unforeseen costs pop up. Speaking of which, bad tenants are another common issue.
Oh, for sure. That can derail an investment pretty quickly.
It really can. I've seen investors who didn't do their due diligence on tenant screening. They skip important checks, like rental history or credit scores, and then they end up with tenants who either don't pay rent on time or, worse, damage the property.
That sounds painful. I mean, I can only imagine the stress and financial loss that can cause.
Yeah, it can get pretty messy. There was a case where a friend of mine, he found tenants who seemed great on paper, but then it turned out they were just really good at selling themselves during the interview.
Wow, so what happened?
They stopped paying after a couple of months, and he had to go through the eviction process, which took time and money. If he'd just taken the time to check their references thoroughly, he might have avoided that headache.
So you're saying do background checks and really vet your tenants?
Exactly. It's worth the effort. And don't forget to trust your instincts. If something feels off, it probably is.
Right. What about cash flow? I imagine ignoring that can be another big mistake, huh?
Definitely. A lot of new investors get so caught up in the excitement of property appreciation that they overlook cash flow.
So, they might think, oh, this property will be worth so much more in a few years. But in the meantime, if they're not cash flow positive.
Exactly. They can find themselves in deep trouble. I had a client who bought a property in a hot area, but the rents didn't cover the mortgage.
Ouch.
Yeah. He was hoping to make up the difference with appreciation, but it took longer than expected, and he was struggling to keep up with the payments in the meantime.
That's tough. So what should investors focus on when it comes to cash flow?
Well, always analyze your potential income against your expenses before you buy. Make sure you have solid understanding of what the market rent is and what your operating costs will be.
That's really good advice. And timing the market, that's another common mistake, right?
Oh, absolutely. People think they can time the market perfectly, but it's so unpredictable.
Like trying to catch a falling knife, right?
Exactly. I had a colleague who waited for what he thought was the perfect moment to invest, but he ended up missing out on a lot of good opportunities because he was too focused on trying to get in at the right time.
So what's the takeaway there?
The key is to focus on your long-term goals rather than trying to predict short-term fluctuations. Real estate is a long game.
Totally agree. Now, let's talk about hidden costs.
Ah, yes. Those can be sneaky. Many investors don't account for things like maintenance, property management fees, or unexpected repairs.
Right, and those can really add up.
I had a case where an investor bought a property and thought they'd be fine with their budget. but then the roof needed replacing just a few months in.
Yikes.
Yeah, it was a huge expense that he hadn't planned for. If he'd done a thorough inspection beforehand, he might have negotiated a better price, or at least been prepared for the extra costs.
So getting a proper inspection before buying is crucial then?
Absolutely, and always budget for unexpected repairs. It's better to overestimate your costs than underestimate.
This is all really practical advice, Mike. It's like you're giving us a blueprint for avoiding these pitfalls.
That's the goal. By being aware of these common mistakes, investors can make more informed decisions.
So, if someone finds themselves in a situation where they've made one of these mistakes, what's the best way to recover?
Well, the first step is to assess the situation honestly, understand what went wrong, and take corrective action.
And that could mean cutting losses or adjusting your strategy, right?
Exactly. If you're over-leveraged, consider refinancing or restructuring your debt. If you have bad tenants, don't hesitate to pursue eviction if necessary.
It sounds like being proactive is key.
For sure. And remember, every mistake is a learning opportunity.
So true.
As long as you're willing to learn and adapt, you can bounce back stronger than before.
That's really encouraging.
It's all about focusing on the long-term vision, you know?
Absolutely.
And with that mindset, you can build real wealth through real estate.
So what should our listeners do next?
Well, I'd say start by educating yourself, and don't be afraid to seek advice from seasoned investors.
Great advice, Mike. And keep an eye out for those red flags we talked about.
Definitely. The more you know, the better equipped you'll be to navigate this journey.
And make it a successful one.
Exactly.
Let's keep that momentum going then.
All right, so let's dive into some immediate steps folks can take right now to get started with real estate funds and LP investing.
Yeah, I think that's really important. It can feel overwhelming, but breaking it down into actionable steps makes it manageable, right?
Exactly. First off, if you're new to this, I'd recommend setting aside a specific time each week to analyze one deal. Just one. You don't have to dive into 100 projects at once.
That sounds doable. So how do they find deals to analyze?
Great question. A good starting point is using tools like Zillow or Realtor.com. They can give you a sense of what's available in your area. You can filter by price, location, and type of property, which is super helpful.
And what about cash flow analysis? That's a big part of investing, right?
Absolutely. For that, you can use tools like the BiggerPockets calculator or Deal Check. They're user-friendly and allow you to input different variables like purchase price, expected rent, and expenses to see how a deal might perform.
Sounds like a serious game changer. Are there any specific apps you'd recommend for monitoring rental prices?
Yes! Rentometer is fantastic for that. You can check rental rates in specific neighborhoods, which helps you understand if you're pricing your property competitively.
So to summarize, we have Zillow for listings, BiggerPockets calculator and Deal Check for analysis, and Rentometer for rental pricing. That's a solid toolkit.
Exactly. And if you can, try to get access to your local MLS. It's a treasure trove of data. Sometimes you can find deals before they even hit the market.
That's a great tip. Now, what about the educational side of things? Are there any books or podcasts that you think are essential for beginners?
For sure. I'd recommend the book on rental property investing by Brandon Turner. It's really comprehensive and easy to digest. And if you're looking for podcasts, BiggerPockets Podcast is a fantastic resource. They cover so many topics and have guests from all walks of real estate.
I love that. It's so important to keep learning. What other habits can someone start forming to set themselves up for success?
Well, one habit is to join a local real estate meetup group. It's a great way to network and learn from others who are on the same journey. Just being around like-minded people can really motivate you.
That's so true. And just getting out there, meeting people can really help build confidence, right?
Exactly. And another habit is to create a dedicated space for your real estate research, whether that's a corner of your dining table or a home office. Having a designated space can help you focus and be more productive.
I love that idea. It makes the whole process feel more official, doesn't it?
It really does. And don't forget to set small, achievable goals. Maybe you aim to analyze one deal per week or read one chapter of a book each week. Just those little steps can add up over time.
That's a perfect reminder. It's all about starting where you are and building momentum, right?
Exactly. And as you do this, keep a journal or log of what you learn each week. It'll help you see your progress and keep you motivated.
Such a good idea. So we've covered a lot. Tools, habits, and resources. It's all about taking those first steps.
Right. So those are some practical first steps. Now let's bring this all together. So as we wrap up today's episode, let's quickly recap some of the key takeaways about real estate funds and LP investing.
Absolutely. First off, we talked about how real estate funds allow you to invest in property without having to manage it yourself, which is a huge plus for busy folks.
Right. And then there's the concept of limited partners. You're essentially pooling resources with others, which can really lower your risk while still giving you a stake in the market.
And don't forget about the potential for consistent cash flow. If you choose the right funds, you can see some pretty decent returns over time.
Yeah, and it's also about understanding the fees and the structure of these funds. Knowing what you're getting into can make a big difference in your investment journey.
Exactly. It's all about being informed and making choices that align with your financial goals. Building wealth through real estate is definitely a marathon, not a sprint.
For sure. And remember, starting in your 40s or even later is still a great time to get into real estate. There's always an opportunity to learn and grow your portfolio.
If you enjoyed today's episode, we'd really appreciate it if you could like, subscribe, and maybe drop a comment about your biggest takeaway or a question you might have.
And hey, if you know someone over 40 who's thinking about investing in property, share this episode with them. It could help them get started.
Oh, and don't miss our next episode. We'll be diving into REIT ETFs for diversification, which is another fantastic way to spread your investments.
Yeah, it's going to be a great discussion. Lots of valuable insights to share.
Thanks for joining us today. We hope you found this helpful, and we can't wait to chat again soon.
Take care, everyone.